Hello friends, myself Mitesh Ajit Save and my presentation topic is mutual fund for the subject of security analysis and portfolio management. Mutual funds. A mutual fund is a common pool of money into which investors place their contributions that are to be invested in different types of securities in accordance with the stated objective. An equity fund would buy equity assets, ordinary shares, preference shares, warranties, etc. A bond fund would buy debt instruments such as debentures, bonds, or government securities, money market securities. A balanced fund will have a max of equity assets and debt instruments. Mutual fund shareholder or a unit holder is a part owner of the fund's assets. Facts about mutual fund. Equity instruments like shares are only a part of the securities held by mutual funds. Mutual funds are also invest in debt securities which are relatively much safer. Mutual funds are there in India since 1964. Mutual fund market has evolved in US and here is there for the last 60 years. Mutual funds are the best solution for people who want to manage risk and get good return. US is very much a part of the market and is not immune to its variance. The prices has rising due to mismanagement of the fund. History of mutual funds. Phase 1 1964 to 87. In 1963 UTI was set up by Parliament under UTI Act and given a monopoly. The first equity fund was launched in 1986. Phase 2 1987 to 1993. Non-UTI public sector mutual fund like SBI Mutual Fund, Canara Bank Mutual Fund, LIC Mutual Fund, Indian Bank Mutual Fund, GIC Mutual Fund, and PNB Mutual Fund. Phase 3 1993 to 96, introducing private sector funds as well as open-end funds. Phase 4 1996, investor friendly regulatory measures, action taken by SEBI to protect the investor and to enhance investor return those tax benefits. Types of mutual fund by structure: open-ended fund, closed-ended fund, and interval fund. By investment objective: growth fund, income fund, balance fund, money market fund, load fund, non-load fund. Other schemes: tax saving scheme. Sometimes the investor invest their money in the mutual fund to get some tax benefits. Advantages of mutual fund: portfolio diversification. It enables him to hold a diversified investment portfolio even with a small amount of investment like rupees 2000. Professional management. The investment management skill along with the needed research into available investment options ensure a much better return as compared to what an investor can manage on his own. Reduction diversification of risk. Uh, the potential losses are also shared with other investors. Reduction of transaction cost. The investor has to the benefit of economic of scale. The funds pay lesser cost because of larger volume and it passed on the investor. Wide choice to suit risk return profile. Investors can choose the fund based on their risk tolerance and expected returns. Disadvantage of mutual fund: no control over cost. The investor pays investment management fee as long as remains with the fund. Even will the value of his investment are decline, he also pay for funds distribution charges which he would not incur in direct investment. No tailor-made portfolio. The very high net worth individual or large corporate investor may find this to be a constraint as they will not be able to build their own portfolio of shares, bonds, and other security. Managing a portfolio of funds, availability of a large number of funds can actually mean too much choice for the investor, so he may again need advice on how to select a fund to achieve his objectives. Delay in redemption. It takes 3 to 6 days for redemption for the units and the money to flow back into investor account. Mutual funds prove best. Will instrument like shares give high return at the cost of high risk? Instrument like NSC and bank deposit give lower return and higher safety to the investor. Mutual funds aim to strike a balance between risk and return and give the best of both to the investors. Sponsor. The fund sponsor any person or corporate body that establish the fund and register it with SEBI, form a trust and appoint a board of trustee, appoints custodian and asset management company either directly or those trust in accordance with SEBI regulations. SEBI regulations also define that a sponsor must contribute at least 40% to the net worth of the assets management company. Trustees created those a document called the trust deed that is executed by the fund sponsor and registered with SEBI. The mutual fund may be managed by a board of trustee, a board of individuals, or a trust company, a corporate body. Protector of unit holder interest. Two-thirds of the trustees shall be independent persons and shall not be associated with the sponsor. Trustee right to trustee approve each of the scheme floated by the AMC. The right to request any necessary information from the AMC may take corrective action if they believe that the conduct of the fund's business is not in accordance with SEBI regulations. Have the right to dismiss the AMC ensures that any shortfall in net worth of the AMC is made up. Trustee obligation of trustee enter into an investment management agreement with the AMC ensure that the fund's transactions are in accordance with the trust deed furnished to SEBI on a half-yearly basis or report on the fund's activities ensures that no change in the fundamental attribute of any scheme or the trust or any other change which would affect the interest of unit holders in it happens without information the unit holder. Review the investor complaints received in and the redressal of the same by the MC. Asset management company act as an invest manager of the trust under the board supervision and direction of the trustee have to be approved and registered with SEBI will float and manage the different investment scheme in the name of trust and in accordance with SEBI regulations act in interest of the unit holders and reports to the trustees. At least 50% of directors on the board are independent of the sponsor of the trustees. Asset management company obligation of asset management company float investment scheme only after receiving prior approval from the trustee and SEBI. Second, quarterly reports to trustee. Make the required disclosure to the investor in areas such as calculation of NAV and repurchase price. Must maintain a network at least rupees 10 crore at all times. Will not purchase or sell securities those any broker which is average of 5% or more of the aggregate purchase and sale of securities made by the mutual fund in all its schemes. AMC cannot act as a trustee of the other mutual fund, do not undertake any other activity conflicting with managing the fund. Structure of mutual fund: custodian has the responsibility of physical handling and safekeeping of the securities. Second, should be independent of the sponsors and register with SEBI. Depositories: Indian capital markets are moving away from physical certificates for securities, and determines with a depository will third will hold the undetermined security holding of the mutual fund. Distribution channels: mutual funds are primary vehicle for large collective investment, working on the principle of pooling funds. A substantial portion of the investment happen at the retail level. As agents and distribution are a virtual link between the mutual fund and investors. Agents is a broker between the fund and the investor and act on behalf of the principal. He is not exclusive to the fund and also sells other financial services. This is a way help him to act as a financial advisor. Distribution companies is a company which sells mutual funds on behalf of the fund. It has several employees or sub-broker under it. It manages distribution for several funds and receive commission for its services. Distribution channel: banks and NBFC. Several banks, particularly private and foreign banks, are involved in a fund distribution by providing similar service like that of distribution companies. They work on commission basis. Direct marketing: mutual funds sell their own products, those their sales of offers and employees of the AMC. This channel is normally used to mobilize fund network individual and institutional investors. Thank you.